Hi, everybody. Welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode, episode 150, we're going to look at a private letter ruling which was just issued today, and we're going to examine, based on this private letter ruling, the general recommended guidance for allocating or not allocating GST exemption for GRAT types of trusts and structures, and where you can go wrong with that, especially when you consider the automatic allocation rules, which were at play in this private letter ruling. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So with the GST exemption, it's a mirror exemption of $11.7 million, which also applies in addition to the $11.7 million exclusion for gift and estate tax purposes. And I've looked at automatic allocation in previous episodes, which I'll link at the end. But if you create an irrevocable trust during life, that's treated as a gift, and there's also automatic allocation rules that apply to the GST exemption in that type of a case. So if there is any GST potential for the trust, in other words, is there any possibility that a skip person, born or unborn, could benefit in the future, then you're going to have the automatic allocation rules apply to that irrevocable trust. Now, the timing is the question here. This automatic allocation will typically apply at earlier of when the trust is actually funded, or in the case of a trust that's subject to what's known as an estate tax inclusion period, this will happen at the close of that ETIP period. So what that means is if there's the potential that that trust could get included in the gross estate of a beneficiary or even the grantor upon their death, typically that just looks to the grantor and the grantor's spouse, then there could be that ETIP period that pulls the assets back into the gross estate and prevents an automatic allocation of the GST exemption. And you can apply GST exemption up front, but it won't necessarily apply until the close of that ETIP period, and it'll apply based on the fair market value at the close of that ETIP period as well, which is a huge deal. Now, you have these automatic allocation rules, but the good news is you can elect out of them on a gift tax return for transfers during life or on an estate tax return for transfers at death. And you might want to elect out, especially if there's this ETIP potential. And ironically, with a grantor retained annuity trust or a GRAT, that's the most classic example of where you see this ETIP problem come up. With a grantor retained annuity trust, as you might know, it's a trust that provides an annuity to the grantor, and maybe sometimes the grantor's spouse, for a term certain. And at the end of that term certain, the trust would terminate and the assets would go to remainder beneficiaries, either in trust or outright. Now, if the grantor dies during the term certain of that GRAT, then the GRAT assets get included in the gross estate. Now, that'll be at the lesser of the date of death fair market value of the GRAT or the annual annuity distribution divided by the date of death 75/20 rate. So because of that risk of estate inclusion with respect to the grantor, there is an estate tax inclusion period, or an ETIP here. That means the GST exemption is usually not allocated to a GRAT when it's funded, but could be allocated when the GRAT terminates. Not only that, it could get automatically allocated at that point based on the fair market value of the GRAT at termination. And at termination, what usually happens is you can choose between whether the GRAT assets pass outright to remainder beneficiaries. And if they're children, you're not going to have any sort of a GST tax issue there. But if the assets pass to a separate irrevocable trust, which might include skip persons like children in issue, what that means is that because of the automatic allocation and ETIP rules, there's also an automatic allocation to this upfront irrevocable trust where the waters could get muddied at the termination of this GRAT based on this ETIP problem. So usually the recommended course of action, if you set it up with a remainder irrevocable trust, or even if you don't, is to elect out of the automatic allocation of GST exemption for both the GRAT and for that irrevocable remainder trust when funded. And you do so through excuse me, through the gift tax return Form 709. Now that sets the stage for today's private letter ruling we're going to look at, because in this private letter ruling, you had an attorney who created both a GRAT and a remainder irrevocable trust for the benefit of children in issue based on that structure we just discussed. But what happened here is that the attorney got thrown under the bus. The attorney was accused of not advising the clients regarding the automatic allocation rules and the ETIP rules with respect to that irrevocable trust and that GRAT type of structure. So as a result, there was no election out made on the upfront 709 for both trusts. And further, when the GRAT terminated, there was no 709 that elected out of automatic allocation then at the close of that ETIP period. So what the clients did is they requested a ruling to get a late election out of the automatic GST allocation. And that's possible under the Treasury regulation that allows for late election relief in the discretion of the IRS, which is Treasury Regulation 301-9100-3. And that one kicks in when you're well past the usual time, usually 6 months to a year, to seek late election relief. There's also a notice here that the IRS cited that really treats this as a timing issue that's not considered under statutory guidance. So combined, those authorities allowed for the IRS to grant this discretionary late election relief as long as they could see reasonable good faith reliance on a tax professional, which there was in this case, because the clients relied on the attorney's guidance or lack thereof in not making the election out, and when the clients could show that there'd be a lack of prejudice to the government in this case. Now, the good news is you do have this relief there, but the bad news is that there's cost to doing so. You have to go pay for a private letter ruling, and that's not inexpensive. And I bring this up because this probably isn't the only type of structure floating out there. There may be other types of GRATs that could be subject to this ETIP rule and which didn't have an election out. So if you're advising a client on this point, it's worth it to dig into those 709s and see, was there an election out? Now, this was a gift that happened after 12/31. That should say 2000, not 2001. If this gift had been before, there would have been a simplified procedure to get election out on late relief under Rev Proc 2004-46. But what's looming on the horizon, if you're looking at this, is that for about 12 years now, there's been a proposed regulation hanging out there that will instead wrap this type of relief into the regulation and may create higher standards for seeking relief, including, a hindsight type of standard. So it's worth it to kind of dig into this sooner rather than later so that you don't run afoul of that proposed regulation if indeed it ever becomes finalized, because at that point it could be much more difficult to deal with this type of issue and much more expensive to deal with this type of issue as well. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.